Good afternoon. Welcome back to my YouTube channel. I hope everybody had a good week. Now, on this video, we're going to be talking about my Crocs price targets and how I got there. If you've been following along, I talk a lot about the qualitative aspect of Crocs and why I invested, and some more operational intricacies. But I never got into the actual quantitative portion of my analysis of why I invested in Crocs. So, without further ado, we'll get into it. Shout out to my new subscribers that recently have subscribed. I hope you're going to get value out of this channel going forward, and thank you for the support. All right, so real quick, we'll pull up our current position here for transparency purposes. I invested about 20 grand into this company. The market has seen a little volatility, but for the most part, we're up. And I just recently got done building this position. As you can see, my buying lots here. I started buying at 116, and then when we went into under 110, I started buying more heavier. And then after it broke the 100 support, I was like, oh, I took a little deeper breath, and then I started averaging in harder and harder until eventually I hit the 20 grand or 20,000 invested mark. So at the top, as you can see, I hold 200 shares. I'm okay with my current position now. I think I own enough stock. Now, if it turns out to where later on the stock rides up, which I anticipate it will, and I tell myself, darn, I should have bought more, that's a good problem to have. All right. So with that being said, let me pull up some price target stuff here. Let's see here. Boom. Here's some projections. Now, when I make my stock projections, I usually do a bear, a base, and a bull case. And this is the bear case, which I anticipate risk of the numbers and everything. All right. So I'm not going to get too much into the actual thesis of the Crocs or in depth. You'd have to go back in some of the prior videos I've been posting about it. So if you just go onto my channel on YouTube and look at prior videos on Crocs, I talk all the time about the thesis and all those. So, but this video is more the quantitative portion of the numbers. All right. So we're about to be done with this year in 2023, and this is the bear case. So the growth rate's pretty much solidified and pretty much done. They grew double digits this year. I know they got one more quarter to report, and they actually sent down their guidance. So, but they're still going to land a little over 10%. So I just put 10% there. So, but in the 5-year projection, which is what I do, I'm a long-term investor. So I always go out 5 years. Anything more than 5 years, even 5 years is a little harder to project out, but anything further is kind of harder to see. All right. So next year I got them growing 0%. Analyst projections here. Let me pull up analyst projections. Through Seeking Alpha, I go to earnings estimates. Analyst projections got them growing next year a little under 4%. On my bear case, I got them growing 0%, and then 5% annualized thereafter on a CAGR. Now, when we talk about investing, there's a lot of confusion from a lot of investors on how they actually calculate price targets and stuff. I like to do it this way. A lot of investors like to project out the future cash flows. I mean, for certain situations that may be appropriate, but for growth investing and how I do it, when I'm in a growth investing stock, this is how I do it. All right. So I use the revenues and I project out the actual growth of the revenues up to 5 years, or whatever my investing time horizon is for that investment. And I come up to the end portion, which on this bear case, we CAGR 5% after next year for the last 4 years. We're coming out to about 4.9 billion in revenue. And here's our net income margins. All right. Has to be net income margins because we're going to be able to, net income is how we assign PEs and multiples off these stocks and how they're going to trade. All right. Now, with that being said, the net income margin is going to be different for every company. Right now, Crocs net income margin is about 17.5. I'm expecting that in the coming years they're going to expand that to a higher net income margin, and the net income margin is industry leading. So because of that, I think that they're going to be able to command a higher multiple later in comparison to their peers. Maybe not as much as their peers for whatever reason, but it should be on par. Now, this is the bear case. So this is going to assume no shares are bought back during this next 5 years. And this is going to assume a depression in the actual net income margin and a depression in growth. A lot of stuff is going to have to go bad with this bear case. But as you can see, after I calculate the net revenues, the net income margin is just dividing the actual revenues, and then the price to earnings is just multiplied by the result of the net income margin. So these net incomes are what the investors like. Think of it as like, how do you say? Like if you have free cash flows for a company, then those free cash flows are going to be used to pay dividends, do buybacks, pay down debt, and whatever. So, but the net income is going to be different from the free cash flows, like I've been saying in the past videos. All right, they're different things. The net income is the actual corporate profit performance of the business, is how you need to look at it. All right, that's how we keep track. All right. So if you're investing for something like dividends, free cash flows is going to be a very important metric because that's what the business is going to use to pay out those dividends. If you're investing for growth, like exponential growth in as far as capital appreciation, like you want the stock to go up, then this in my opinion is the best way to calculate your price targets going out. Now, what do you think is going to be fueling the buybacks and the shares outstanding? Well, it's going to be the free cash flows, and that's one piece of the puzzle that contributes to the value generation of what you're going to get as a return as a shareholder. Now, this assumes no shares are bought back. Shares outstanding are going to be 61.6 million. And that's going to be divided by the net income, which will be EPS, right? Earning per share. If they buy back more stock and there's less stocks outstanding or less shares outstanding, EPS will spike up and there will be a higher multiple assigned. I'll make an example. All right. Bring this calculator over. So let's say that we're going off of net income on a 17% net income margin. That will be 835.24 divided by shares outstanding, 61.6. So every share is going to earn $13.55. We'll say that the multiple that it's going to trade at is 9. So boom, you get a price target of $122.03. That's just an example of how it works. All right. Now, this assumes that, once again, this assumes margin compression and language growth and lack of execution. And also it assumes that a lot of the debt is not going to be paid off either. Part of the main thesis of what I have is, upon their repayment of the debts, as the debts go down off the balance sheet, credit rating agencies will recredit Crocs, and they should command a higher multiple because their corporate credit rating will go up. All right. So when their corporate credit rating goes up, they will be seen as a less riskier investment, and the financial institutions in turn will start receiving inflows, and institutions will start buying the stock more, and it'll command a higher multiple or a higher PE. All right, but for now, I think we're trading at like a 9 PE right now. Okay, let's go to my base case. All right, so this assumes that we grow 4% next year, and then Crocs will grow 8% every subsequent year up until the final year of 2028. Once again, I reiterate, these are 2028 price targets going 5 years out. All right, so you'll see more expanded multiples, and this is based on repayment of their debt, more buybacks, a better efficient business to get more credit. All right, and a lot of this is going to be banked on their growth in China and Asia. This also assumes a 25% buyback, which I think that is pretty low. I mean, I think in 5 years they'll buy back much more than that. But realistically, I think we're gonna land. I think my stock's gonna land somewhere in this range right here, maybe between 17 and maybe it gets to a 19 PE at a 18% margin. It's going to land around. I think I have a lot of conviction my price target's going to really and realistically land over here. But hey, that's investing for you. You can't tell the future, but you can try to guesstimate on where you think it's going to land. But I mean, a good investment is a good investment. All right. So let's go to our bull case where things get exciting. All right. Let's say they grow 5% next year and they CAGR at 10% until 2028. They do double-digit revenue growth. Margins expand to 21%. I think this is possible. In January, their new redistribution center up in Nevada is going to be fully operational. I think we will get synergies we'll get margin synergies for expansion based on that redistribution center and the reestablishment of our supply chains coming up next year. And in combination, remember that we're expanding internationally. So on a constant currency basis, even though we're going off a constant currency basis, maybe LIBOR or what have you may play a factor in the international rates, but it really doesn't matter because I think our interest rates are going down in the United States, and during that portion, real estate or during that portion, interest rates will be going up. So international currencies will probably be strengthening as we're easing. So that's good for Crocs because the price of their dollars will be more, and that should create alpha for the actual payouts. All right. So anyway, here's my price targets. I think that this is gonna take excellent execution. This is gonna assume a 35% buyback. That's the company's buying back 35% of all shares outstanding, and if they do this and they pay down the debt, they buy back the stock, pay down the debt, they expand, they grow their revenues double digits, expand the net income margin, we can be looking at some substantial exponential gains. I'm talking 5x, even up to a 9x is possible. Let's look at their competitor. If I get a 9x in 5 years out of this stock, I'll admit I'll be surprised. And even though I projected a 9x technically because I'm on here projecting it now, I'm going to be humble about it and say, like, if it happens, I'm not going to come up here and say, hey, I'm an investing god or anything. Okay, I projected a 9x with this company. Nah, there's no way that I'm going to be able to, but at the same time, I'm not coming up on here and saying, I think this stock is going to be $900 in 5 years. That's not what I'm saying either. All right. So take that for what it is. Honestly, it's hard for me to see this thing 9xing in 5 years. I think base case, maybe we get a 3 or a 4x in all reality in 5 years is possible. And let's look at some, how do I get up to PE expansion? Why do I think that? Where do I get comparables on PE expansion? So let's go to peers. Let's edit some symbols. Sure, I'll keep Puma and Skechers, and I'll put, let's see here, Nike on comparable companies. We'll go to valuations. Bear with me. And if you can see, let's go to, if you look at all the PE gap metrics on valuations of what the companies are trading at right now, and this is a high interest rate, austere financial environment right now. Nike's trading at a 35 PE, Skechers at a 17, and Puma's trading at a 27. I mean, my take on it is maybe I'm with the Crocs has better margins, better growth, better management. If you ask me, better leadership. They should be commanding more of a PE than these other companies anyway. The only reason why they're not commanding a higher PE is the debt. And according to the company, I mean, they're already starting to pay down the debt. They've already committed to say we're going to start buying back stock and paying down debt. So that's coming. All right. So that's my take on the price targets. I hope that you got some value out of it. I will be coming out with some more videos later. I appreciate everybody's support and hope everybody had a good week, and I hope everybody enjoys their weekend. Thank you.